All right, let's turn to the markets right now. You can see we're a little soft right now. You get stocks, however, the Nasdaq's higher, just getting ready for the big day, right? Investors are keeping this eye on all these different events that are happening. It's a very, very busy week for these markets. First of all, the biggie is the Fed. Wall Street's paying a whole lot of attention to the Fed to figure out what they're going to do with their two-day policy meeting. The expectation is that they're going to raise rates probably by a quarter point. This would be following last week's strong February jobs report. So in other words, the economy hopefully is on strong enough footing that we can start to move into a higher interest rate environment. The big key, though, to find out from the Fed is just exactly how often these rate hikes are going to come. So we're watching for that. Meanwhile, we're also watching the European markets because Britain is entering talks to pass new legislation that would initiate the process to leave the European Union. This is the whole Brexit thing playing out in real time now, and the bill could pass through Parliament as early as tomorrow. But take a look there. European markets shrugging off concerns of this right now. Joining me right now on set, Bullseye Brief author and founder Adam Johnson, along with Recon Capital CIO Kevin Kelly. Good to see both you guys. Adam, are you worried about anything right now? I mean, Brexit going on, the Fed looking to raise rates.
Love it. Look, mission accomplished over at the Fed. They have a dual mandate: full employment and price stability. They accomplished both of that. So it's time to get us back to normal, create higher interest rates so businesses can make rational decisions. And by the way, retirees can finally get some income. And as far as Brexit, that was the most brilliant decision the Brits have ever made. Get rid of the EU. They don't need it. So, yes, I'm very positive.
So you think the markets are going to be able to interpret all this just fine? I mean, hey, a lot of investors have been looking for the opportunity to have higher rates because it suggests more positive things about the economy overall, Kevin.
Yeah, I mean, this is the biggest week. I mean, you have the Bank of Japan as well as the Bank of England. So they're going to be looking at and assessing trade policies and how it's going to dictate their rates. And I think investors can be worried here and want to focus on what the Fed does because they want to see guidance going forward. We saw volatility come in very pronounced after the first time they raised rates. They indicated 4 rate hikes. Right now, the market's anticipating 2 being priced in. It'll be fine with 3, but anything outside of that, that'll spook the markets because they want to see a gradual rise.
So let me ask you about this. Multiple. The front page of the New York Times this morning, there was an article about the Fed and saying effectively that Donald Trump was totally at odds with Janet Yellen. In other words, she's trying to go this way to slow the economy down. He's trying to go this way to rev things up. And I thought, maybe that's not such a fair characterization, right? Because she's actually looking to make sure she wants economic growth. She just doesn't want it to become inflationary.
Well, again, the Fed has this dual mandate, one of which is price stability. And so she wants...
Again, no inflation,
correct,
right? Let's keep prices sort of here. You want a little, but nothing crazy.
It's slow inflation right now. It's not getting out of hand. The Fed is worried if it would get out of hand, but they're not seeing that, especially because we're seeing wages rise, but not at a great rate. And that leads to healthy inflation. So the Fed's looking at...
I'm going to play devil's advocate for a second, because this piques my interest. If we're just getting a teeny bit of inflation, why does she need to move right now?
Because rates are so low. They have never been this low. The Fed funds rate is still 3/4 of a point. I mean, think of how low that is historically. That's nowhere near normal. Typically, you have about 3 to 3.5%. All she is doing is getting us back to some sort of normal threshold, again, so that businesses can make rational decisions and retirees can finally get some income in their retirement accounts. It's just getting back to normal. We're not normal yet.
This is very important, though. You're saying businesses make rational decisions.
Yes.
In other words, Kevin, when money's free, when money's cheap, perhaps people don't make the most rational decisions. You need a little bit more of a push-pull in the ability to go out and spend this money?
Yeah, and I'm glad you bring that up because in regards to the Fed, businesses are looking at fiscal policy to drive the economy further, no longer the Fed. They were worried about that easy monetary...
right?
Yeah, that's exactly it. So now businesses are more comfortable in reinvesting in property, plant, equipment, labor. They're willing to spend because they think that's going to grow. As we talked about the easy monetary policies, a lot of companies were doing stock buybacks because they weren't comfortable with the policies coming out of Washington. Now they are in reinvesting in their future because of the regulatory environment and because of the fiscal policies that should stimulate the economy.
By the way, it's very important. If you're running a business and all of a sudden you know that rates are going up, you're going to make some decisions now that you might not have made if rates are going to stay low for a long time. I think that's also going to create dispersion among companies. Some are going to do well. Some projects will make sense. Others won't. Some companies will do well. Others won't. It's actually a great time for stock pickers. As a result, we finally have some diversity in the economy.
Also the net interest deduction may be taken away on the future tax policy, so companies are evaluating that right now as well in regards to future borrowing, so they may be deleveraging.
So where do you see this heading? I mean, just, as we go through summer and into fall, I know you think 24,000 is a possibility.
Well,
is that this year,
no,
or is that
23,000 is...
Okay, 23,000 for this year?
Yeah. And I'll tell you why. Because earnings have been... have effectively been flat. Operating earnings for the S&P 500 have been $118 for the past 3 years. This year, based upon the consensus estimates, they're going up to, call it about 128.
Okay.
That doesn't even include any of the potential benefits that we get from tax reform or regulatory reform. So we know we have earnings growth for the first time in 4 years. We may get a kicker that comes from the White House.
It's going to be very hard.
That to me is enthusiastic.
To bring this back to as we start the show talking about healthcare reform and the politics of all of that, if you start seeing 23,000 on the Dow, if you start seeing jobs reports like what we saw on Friday and they are consistent, I don't know what people are going to have to complain about, Kevin.
And they're small businesses hiring, so that's why people are actually focusing on the large cap names like the Dow as opposed to the Russell. The Russell has given up a lot of the gains because everybody's focused on tax policy coming later on in the year, and that would have benefited if it came earlier, the small cap. So that's why people are focusing on Dow and talking about 23,000.
It's a nice looking chart. Thank you so much, Kevin. You can check out Adam's individual investment ideas in his newsletter.